to the Short Vol Show live, broadcasting live from Cape Cod, Massachusetts, home of the Pilgrims. My name is David Lincoln. I used to go by the badge DEW at the CBOE. I was a market maker specializing in illiquid equities, and I also did a brief stint trading the 10-year and then the 30-year bond options pit at the Chicago Board of Trade. So as we're coming in today, you can, if you obviously clicked on this video because you saw the title, I continue to ride the short train in GME. You know, I had losses at the beginning of this year trading GameStop that I still haven't recovered from. However, it's been a fruitful last, I'd say, 3 weeks where I've gained back a decent amount of money, which is great for me, but that's not what I'm here to talk to you about. I'm here to just kind of show you part of my different parts of my trading journey so that hopefully you can benefit yourself from some of the mistakes that I've made and won't make them yourself. Also, just kind of talking through my thought process with things. The other thing that I do is I educate people on the VIX and whatnot. So let's take a quick look at GameStop here first, and then we'll look at the VIX. We can see the chart behind me is the last couple days, and you can see the Friday session we had a rally that kind of collapsed. That's been a common theme lately of we get these rallies and then they just don't turn out well. Now, earlier in the year with GameStop, we had rallies that turned out great. You know, everybody would jump on board, the stock would explode to the upside, and everybody would make money who was long, and it was happy times for those long. And of course, when something works for a little while, it's great, and then things change. Inevitably in trading, things always change. There's no formula to make money, and but there are trends, but adjusting and figuring out when a trend changes is one of the more difficult things in trading. However, right now, we are on a downtrend, and that's how I've been making money, being short this. Now, there's different ways to short a stock. I don't actually trade the actual stock for a number of reasons. One reason is just to limit my risk to the upside. If this stock were to explode back to the upside, you know, we did see it go to almost $500 earlier in the year. If that were to happen, and I was just short shares, I could risk losing all the money in my account plus some. And so the last thing I want to do is to owe TD Ameritrade a bunch of money, or whoever the brokerage firm is. So instead of actually shorting shares, I use various options strategies to create the equivalent of being short shares. And so right now, in that sort of equivalent, if you were to compare my position to actual stock shares, if I pull up my Analyze tab, it is incorrect. It must have some theoretical trades in here. Let me get rid of this. Yeah, it has one trade that's not actually there, and oh, here we go. So if in the most basic terms, my position, I'm short the equivalent of 22 shares of GameStop. So not a huge amount of risk. 22 shares, 22 deltas. You can see to my right there. I know it's kind of fine print if you're watching this on a phone, but 22 deltas short. That means a couple things. One thing it means is that for every dollar this stock goes down, I make $22. Every dollar the stock goes up, I lose $22. And you can see the line above the one that I'm pointing at here is what happens if the stock moves up 10%, and the line below is what happens if the stock moves down 10%. So and you can see the delta has changed, right, between up 10% and down 10%. Well, why is that? That is because of the specifics of the option position I have on. Now, for those of you who want to get slightly more technical, I'm going to blow this up a little bit. Okay, so here you can see the quote-unquote Greeks of the position here, and you can see that All right, so here I'm short 22 deltas, but down 10%, I'm only short 2 deltas, right? And up 10%, I'm short 30 deltas. So it's changing my stock equivalent over time. And that is due to the nature of the position I have on. And now that I've sort of blown this up in size, let me move it over a little bit so you can actually see the position I have on here. And it is a condor, which basically means that I have four options positions that result to me it being most advantageous to me if on the expiration of these options, which is in like about a month's time, the stock be between the price of 125 and 170, right? So right now stock is 164. So we're right in the middle of that range. But I have set up an options position where I am making a bet that the stock will fall within the range of between 125 and 170 in a month. Now, when I first put this position on, the stock was higher than this. It was around, I think, 190 or 200. And so it was out of that range when I first put this position on. But as the stock has moved lower, it's come into the middle of this range. Now, I'm not sure if I will leave things like this forever, but we can make some sort of like we can examine what this position means a little more closely by looking at the pricing we have here. So, for example, this could be thought of as two put verticals. So it could be thought of as, well, I sold the 170, 180 put vertical, right? So that's a $10. Between the 170 and the 180 strike is $10. The distance between these two strikes is $10. So the most the spread can be worth is $10. And I own this spread. So I want, so the best thing for me would be if the stock is at or below the 170 price on expiration. Currently, stock's trading around 164. So it's $6 below the price, which is, pretty close to the price. But if expiration were to occur today, I'd be a winner. So if the stock is below or at 170 on expiration, this spread, it will be worth $10, right? So let's see what the spread's worth now. So if we do some quick math here, if the spread was worth $10 and I have 8 spreads on, then the 8 spreads on expiration will be worth $8,000. Let's see what the spread is worth right now. So if I go in, I look at the option prices, and obviously the markets are closed right now, but this is going to be what this was worth when we closed with stock trading 169. And it might be slightly inaccurate because there's wide markets here, but it says $6.50. So right now the spread's worth $6.50. It could be worth up to, what did we say? $10. So if we multiply 650 by the 8 spreads, right now this part of my position, the 180, 170 put spread that I'm long, is worth about $5,200, right? If stock stays below 170 through expiration, it will be worth $8,000. So there's still almost another $3,000, right? Because 8,000 minus 5,000 is 3,000. So still $3,000 more dollars can be made here if we hang out for the next month and the stock stays below 170. Okay. Now let's look at the other side of the trade. So the other side of the trade is this spread I'm short, the 125, 115 spread. Now this side of the trade, we are short. So we want the stock price to stay above 125. So and just to go back to that first part, the 180, 170 put spread, if the stock ends up above that 170 line, then that spread will not be worth $8,000. It'll be worth less. And if the stock ends up above $180 on expiration, then that spread will be worthless. So right now, $5,000, $5,200 actually of the worth of this account is tied up in that one spread. So if the stock were to explode to the upside now and stay up high, that $5,200 is at risk, right? So I want to give you the good news and the bad news here when we look at this. Okay, so let's go check out the second part of this. So the second part of this is this, the 125, 115 put spread that we are short. And let's take a look and see what this is priced at right now. So I'm going to go once again over to my options screen here, and I'm going to click on the offer of the 125 put. Then I'm going to hold control and click on the bid of the 115 put. And right now, this spread is worth $1.48, right? So, if this stays above 125, then I will collect an additional $1.48 times 8, right? On expiration. However, the bad news is that this could go from being worth $1.48 all the way up to $10, right? So I could lose potentially $8.50, $8,500 on this spread if the stock, let's say, the selling accelerates and the stock starts moving rapidly down towards through 125. Let's say the stock goes to $100 today, then all of a sudden the spread that I'm short could blow up in my face, and I could lose up to $8,500 on it. So there's some real risk going on here. I find it amusing how many people online in the chats and whatnot like to say, "Oh, people that are short are the bad guy, and the system's rigged and they're manipulating and everything." Everybody here is taking risk, and so and just because you take risk doesn't mean you're going to be rewarded, right? A lot of us, that's the whole thing about being a trader, is you can go into work every day and trade and still and work real hard and still at the end have nothing to show for it. That's part of the game of trading. But so anyway, so let's go over this for a second. So this spread is currently worth 148. So if I multiply 148 times 8, I get $1,184. So right now this spread's worth $1,184, but I'm short it. So if we continue to move lower at a rapid pace, and on expiration the stock is below 115, then I will lose basically 8,500 times 8, which is 6,800. So that's kind of the risk I have. Now, if stock were to end up at $100, right? That first part of the position, the 180, 170 put spread, that would end up being worth $10, right? So $10,000. That would be worth $10,000. This spread here, however, would be worth basically, I'm short it, and it would be worth $10, and so I would lose $10,000 on the bottom part, and I would make $10,000 on the top part, right? So it would end up at zero. However, I did sell this for $1.48, so I wouldn't lose a $10,000 total. I would lose 8,500 times 8, right? So it's not like it would be a total loss. However, what would really happen if this stock started to move lower is I would adjust the position. Sometimes when we look at these options trades, we think, oh, well, as if, well, we're not going to do anything till expiration and we're locked in. We're never locked in. Any day the market's open, we can go and we can move out of these positions. So if it starts to move out of this range one way or the other, we can bail on the position. So it's actually not as risky of a position as it sounds like. If it were the situation where you had to put a position on and you weren't allowed to adjust at all until expiration, you just had to leave it the way it was, that would be much more risky than the situation we have now where it starts going against me, I can get out of it, right? And indeed, even if this position works out perfectly and stock stays, let's say stock just sits at $150, if we got within 3 or 4 days of expiration, I would still probably take the position off, even not at maximum profitability, just to avoid that risk of, there's all this money in the account and then some random things happens one day before expiration and it's all wiped out, right? So every day you have risk on is another chance for something to blow up in your face. So we want to keep that in mind. And when I trade options, I like to keep the expiration out a decent amount of time so that if something bad does happen, there's time to recover. The other significant thing about this position, if you look, is this theta number here. And this means that by the nature of this position, as the days go by and we get closer to expiration, and these two things happening get closer to fruition, thus this spread becoming worth $10 and this spread becoming worth close to zero, pricing adjusts, and so this position is basically collecting $28 a day as long as I don't touch it. And it's not a ton of money, but it's something. And for example, on Friday, when this position, the stock went all the way up to 179, and I just left it, and then it came back down. Well, when you see that number of $28, you can remember, or what was it, 21? Right now it shows 21, but when you see that number, that theta number, you can remember that on the weekends, you just collect that money for both Saturday and Sunday without even having any risk or anything, right? So there's a little kicker when you're short, when you're collecting theta, you get that weekend kicker where you get the extra money for the weekend days when the market's closed. Conversely, if you were long and you're having to pay theta, you'd have to pay it for the weekend when the markets are closed. So there's that to take into account too. So if you think it's $20-something right now, Friday, if you count Friday, Saturday, Sunday, Monday, between those 4 days, that's $100 going in your pocket. So that's a good thing. Now, so my strategy moving forward is if we continue to roll lower, I will probably pare back the short side of this position, the 25-15 put spread. But ideally, I would like to buy back that put spread for a cheaper price than I sold it for. So if we go back in time here, let's go back and just look and see if we can really quickly here figure out what we sold this for. Now, I remember what I sold it for, but I want to go on the screen and show you how we find this. So if we go to account statement here, and I can look at, let's see how to do this. I want to go back a couple days here. So I'm going to go back, transactions, history. And I can look back and see what I sold it for, but basically, I sold this spread for, right now it's trading 148. I sold it right around that area. I believe I sold it for right around $2. So, it's going to decay at kind of a strange rate because it is kind of out of the money right now. So, but we'll keep an eye on that. Right now, I do have 1,400 in buying power in the account, so I can buy these spreads. And ideally, if we start to roll lower, I'll slowly buy those spreads in as we get closer to strike because I don't want to give up. I want to stay short. And as when we look at the Greeks, you can see here I'm slowly getting less short over time. So I want to maintain that short as we get closer there if we move lower. But if we just stay here, I'm just going to leave the position. Anyway, sorry for that little bit of downtime, and I didn't show my past trades because I can't figure it out for a second. But I'm not going to waste your time thinking about it in front of you. I'll figure out how to do that and go back to that next time. Anyway, so that's kind of where we are right now. Let's take a look at the overall market. I pulled up some of these other meme stocks, which all appear to be a little bit down. AMC's down a little bit, and the VIX was up. VIX is up a little bit because we've got E-minis down 52, NASDAQ down 134. So we're coming into a down day here today. Dow futures indicated down 500. So we'll see if the sell-off continues. I'm kind of in my own little GameStop world, so I wasn't really even paying attention to the market, but when you've got the VIX popping here, this is certainly an opportunity to consider jumping into a short, right? Because look at the pop in the VIX here. Let me move myself down so it's not distracting. But we got a little pop in the VIX here, and which is bad news if you're already short. But if you're not short, it might be a chance to jump in here. UVXY back to 30. Almost 32. Remember, we've been flirting with 30 for a while in UVXY, right? But you can see this pop here. This might not be a bad place to just put a little short on. Usually when we get a little pop like this, it only lasts a day or two, and then everything's back fine again. I can't tell you what the future is going to bring. This down move could continue. However, certainly a better place to short than, down 2 days ago when UVXY was 27. So I'm considering maybe putting initiating a small short in either UVXY or VXX. And, it would be a similar strategy to kind of the one I'm using in GameStop. And it's not that my only game is buying put spreads. It just happens that it would be a similar strategy to the one that I'm employing with GameStop would be to, for example, VXX right now up to 32. It was just 29 a day or two ago. So something I would look at might be September, something like the September 30-27 put spread. So if I were to buy the 30 put, it's not going to have good prices because these are prices from when we close. But try to buy the 30-27 put spread for, I'd say about like $1.50. That way you could double your money if this goes back and closes below 27 and expiration in 60 days, which is pretty likely. We take a quick look at the VIX term structure. Although the VIX is up 3 points, the term structure is still in contango by, well, not as much as it was before, by 4%. We've got expiration coming up very soon. So I would disregard the first month, but contango between the second and third month is still 4%. If we do see a continued pop in the VIX, this chart could flatten out. But for now, still a very healthy VIX chart, which is more evidence that maybe putting a small short on wouldn't be a terrible idea, because if the VIX was really, really spooked, this chart would not be upwardly sloping like this, right? It would be flat or it would be sloping in the other direction. Backwardation means when the front month future is higher than the second month future. I would disregard the front month future right now, so there's only 1 day till expiration. It's almost moot right now because the ETPs contain almost no July futures. All ETPs, August future is everything for VIX ETPs at the moment, and it'll slowly start to roll out to SEP as the days go by. But we'll see what happens on this down morning in steamy hot July. Coming up on my 50th birthday in just a couple days, so I'm almost halfway home. Anyway, thanks for watching, folks. Best of luck with your trading. I'm going to try to make this a little bit shorter next time. I kind of rambled a little bit this time, but I hope you got something out of it. I appreciate everybody checking it out. Please support me on Patreon or through the membership program. Thank you so much. Good morning, Tom. What's going on, everybody else? And I'll check you in the next one. Thanks for watching. Bye, guys. You're watching Famous Dave.